The year is 2025, and an economic storm of unprecedented magnitude is gathering on the horizon for the United States. Warnings, once whispered in academic circles and niche financial forums, are now blaring from mainstream analysts. We are not merely discussing a minor downturn. We are confronting the very real prospect of a systemic U.S. debt crisis, a scenario where the nation's ability to manage its colossal financial obligations comes under severe, potentially catastrophic strain. The core of this impending crisis revolves around a confluence of factors, each a significant threat in its own right, but devastating when combined. Current U.S. national debt has surged past an astronomical $36 trillion. To put this into perspective, this year alone, a staggering $9 trillion of that debt needs to be refinanced. This isn't just a number. It represents a critical vulnerability. Refinancing means the U.S. Treasury must find new buyers for its bonds, or convince existing holders to reinvest, at a time when global economic conditions are anything but stable. Compounding this already precarious situation are specific policy decisions and market dynamics. Proposed aggressive tariffs, aimed at restructuring trade balances, carry the significant risk of stoking inflation and retaliatory measures, further squeezing the economy. Simultaneously, a substantial tax cut package, recently passed by the House, threatens to balloon the deficit even further, adding more fuel to the debt fire. These aren't abstract economic theories. They are concrete actions with tangible consequences for the government's balance sheet and the perceived creditworthiness of the United States. The very foundation of America's financial stability is being tested. The bond market, often seen as the bedrock of the financial system, is showing deep fissures. Investors, the very entities the U.S. relies upon to fund its operations, are growing increasingly wary. This isn't quiet concern. It's manifesting as a bond yield rally, a technical term for a situation where interest rates on government debt are forced upwards due to a lack of demand at lower rates. Specifically, the U.S. 20-year Treasury bond yield has alarmingly surpassed 5.104%. For the non-financially inclined, higher yields mean the government must pay more to borrow money. This indicates that investors perceive U.S. debt as riskier than before and are demanding a higher premium for holding it. Think of it as the nation's credit score taking a hit, making its mortgage payments, its interest obligations, more expensive. This reluctance from investors to buy U.S. debt at previous rates creates a dangerous supply-demand imbalance. The Treasury needs to sell bonds, but buyers are scarce unless the price, or rather the yield, is exceptionally attractive. This is a classic demand shock. Esteemed investor Ray Dalio, founder of Bridgewater Associates, has been vocal, warning that investors are visibly shifting away from U.S. debt, a clear red flag signaling a loss of confidence in the long-term stability of U.S. financial instruments. This isn't isolated nervousness. It's supported by observable market phenomena. Gold and Bitcoin, traditional safe havens and inflation hedges, have soared to all-time highs, indicating a flight to assets perceived as more secure than fiat currencies tied to government debt. Moreover, the average 30-year fixed mortgage rate for American homeowners has climbed above a painful 7.4%, directly impacting household budgets and the housing market, a consequence of these broader bond market stresses. The signals are unambiguous. The market is sending a clear message of distress. So why is this bond market turmoil erupting at such a critical juncture? A large part of the answer lies with the Federal Reserve, America's central bank, which finds itself caught in an incredibly difficult bind, a classic rock-and-a-hard-place scenario. Historically, during times of economic stress, or when the government needed to issue large amounts of debt, the Fed could step in as a buyer of last resort through a process known as quantitative easing, or QE. QE involves the central bank purchasing government bonds and other financial assets to inject liquidity into the money supply and lower interest rates. While QE can help stabilize markets in the short term and facilitate government borrowing, it's a powerful tool with significant side effects. Notably, the risk of stoking inflation, if overused or poorly timed, and potentially contributing to asset bubbles. However, the current environment is drastically different. The Fed has spent the better part of the last 2 years actively fighting inflation, which, despite some moderation, remains stubbornly above its target levels. A key part of this fight has been quantitative tightening, QT, the opposite of QE. This involves the Fed reducing its massive balance sheet, which had ballooned during the pandemic response. Since its peak in early 2022, The Fed has been systematically shrinking its holdings of Treasury securities and mortgage-backed securities, effectively pulling money out of the system. This tightening is crucial context. The Fed is no longer a net buyer of US debt. It is, in fact, reducing its exposure. This means one of the largest traditional buyers is off the table, exacerbating the supply-demand imbalance in the bond market. The Fed is now faced with two disastrous options. Option 1. If it reverses course and starts buying US debt again, restarting QE, to suppress yields, it risks undoing all its hard work fighting inflation, potentially leading to a resurgence of runaway price increases. This would then necessitate even higher interest rates down the line, risking a much deeper and more painful recession. Option 2. If the Fed stands pat and does nothing to intervene in the bond market, yields could continue to surge as investor confidence wanes. This would dramatically increase the US government's borrowing costs, forcing it to allocate more of its budget to interest payments, potentially necessitating massive spending cuts, or paradoxically, printing even more money to cover the higher interest, which itself is inflationary. The Fed's hands are, to a large extent, tied by its primary mandate of price stability, making a rescue operation for the bond market exceedingly complex and fraught with peril. As if the existing pressures weren't enough, recent and proposed fiscal policies are actively fanning the flames of this potential crisis. Two primary culprits stand out: aggressive trade tariffs and sweeping tax cuts. Let's examine tariffs first. While often touted as measures to protect domestic industries and correct trade imbalances, tariffs are, in essence, taxes on imported goods. These costs are typically passed on to consumers in the form of higher prices. Federal Reserve Chair Jerome Powell himself, while noting inflation has come down from its 2022 highs, has explicitly warned that the imposition of new, broad tariffs would almost certainly lead to an increase in consumer prices, thereby reigniting inflationary pressures. Beyond this direct impact, tariffs can slow overall economic growth by disrupting supply chains, increasing input costs for businesses, and potentially leading to retaliatory tariffs from other countries, which can harm US exports and further escalate global trade tensions. Some analyses, like those from the Budget Lab at Yale, have shown specific, tangible impacts. For instance, past tariffs led to apparel prices rising by as much as 17%, a clear example of their regressive nature, disproportionately affecting lower and middle-income households who spend a larger portion of their income on essential goods, like food and clothing. Now, let's turn to tax cuts. The House recently passed legislation that, if enacted, is projected to significantly reduce government revenue. While proponents argue tax cuts stimulate economic activity, a major concern, especially in the current high-debt environment, is their impact on the budget deficit. Forecasts indicate these tax cuts could add approximately $600 billion to the annual deficit. Over a decade, this could swell the national debt by an additional $6 trillion, a colossal sum. Both of these policies, tariffs and tax cuts, share a common, problematic outcome in the current context. They are inherently inflationary, and they expand the budget deficit. Inflationary pressures make the Federal Reserve's job even harder, potentially forcing it to maintain higher interest rates for longer, or even raise them further. An expanding deficit means the government must issue even more debt to cover its spending, further flooding a bond market that is already struggling to absorb the existing supply. This increased supply of bonds, without a corresponding increase in demand, inevitably pushes yields higher, worsening the very crisis we are discussing. It's a vicious cycle where fiscal policy is actively undermining monetary stability and exacerbating the nation's debt burden. Where does this toxic brew of massive debt, uncooperative bond markets, a constrained Federal Reserve, and exacerbating fiscal policies ultimately lead? The potential endgame scenarios are deeply concerning, extending far beyond a typical recession. We are looking at the possibility of severe domestic fallout and immediate dangers to the financial well-being of everyday citizens and the stability of the US economy. If bond yields continue their upward spiral unchecked, the cost of borrowing for the US government could become unsustainable. This would force incredibly difficult choices. Draconian cuts to essential government services. Think Social Security, Medicare, defense, infrastructure projects. Or significant tax hikes on an already strained populace. Or, as mentioned, resorting to inflationary money printing on a massive scale, simply to meet interest payments. Any of these paths would likely trigger a severe economic contraction. Businesses, facing higher borrowing costs and declining consumer demand, would scale back investment and hiring, leading to widespread job losses. The housing market, already sensitive to interest rates, could experience a more profound crash. The value of retirement savings, heavily invested in stocks and bonds, could plummet. The purchasing power of ordinary Americans would be further eroded by persistent, or even accelerating, inflation if the government chooses the printing press route. This isn't just about numbers on a government ledger. It's about the real-world consequences for employment, for savings, for the cost of living, and for the social fabric. The risk of a sovereign debt crisis, while once unthinkable for the United States, is no longer a fringe theory. It's a scenario where investors lose so much faith in the government's ability to repay its debts that they refuse to lend at almost any price, or demand yields so high they effectively bankrupt the nation. The immediate aftermath could see a sharp devaluation of the US dollar, making imports drastically more expensive and further fueling inflation. Access to credit could dry up across the economy, paralyzing commerce. The stability that many have taken for granted could evaporate with shocking speed, leading to a level of economic hardship not seen in generations. The ramifications of a US debt crisis would not be confined within American borders. Given the US dollar's status as the world's primary reserve currency and the interconnectedness of global financial markets, a US default or severe uncontrolled inflation would trigger a global monetary breakdown. Ray Dalio has starkly warned of this, suggesting we could be facing a once-in-a-lifetime disruption to the global monetary order, potentially more severe than the collapse of Bretton Woods in 1971 or the global financial crisis of 2008. Such a breakdown could see the US dollar significantly devalued, not just against other currencies, but against real assets. This would disrupt international trade, as contracts and commodities priced in dollars would face extreme volatility. Countries holding large reserves of US Treasury bonds would see the value of those assets decimated, potentially triggering their own financial crises. Global supply chains, already fragile, could shatter. The search for a new global financial anchor could be chaotic and prolonged, leading to a period of profound economic instability worldwide. The trust that underpins the entire international financial system could erode. So, what can individuals do when faced with such monumental and systemic risks? While the big picture is daunting, there are prudent steps. Firstly, extreme caution with investments is paramount. Assets directly tied to the value of fiat currencies, particularly those heavily reliant on government stability, may carry increased risk. Diversification becomes even more critical, not just across asset classes, but potentially across geographies and currency exposures. Where feasible, the recent all-time highs in gold and Bitcoin are, as mentioned, indicative of a broader search for stores of value outside traditional government-backed systems. These assets are often seen as hedges against inflation and currency devaluation. It's vital to stay informed from credible sources, to understand the mechanisms at play, and to avoid panic-driven decisions. Financial literacy and a clear understanding of one's own risk tolerance are essential navigational tools in such turbulent times. This is not about predicting the exact future, but about preparing for a range of plausible and potentially severe outcomes. The US debt crisis is a ticking time bomb, demanding our attention and preparedness.